15 places where property insurance just disappeared. Homeowners are trapped. So here's a fun little fact that's going to ruin your day. There are places in America right now where you can't get home insurance. Not because you have bad credit. Not because your house is falling apart. You can't get insurance because every major insurance company looked at your zip code, did the math, and decided they would rather abandon billions of dollars in potential revenue than take on the risk of covering your house. State Farm left. Allstate left. Farmers left. AAA left. And they didn't leave quietly. They sent out cancellation notices to hundreds of thousands of people and basically said good luck figuring this out on your own. Which means right now, across huge swaths of Florida, California, and Louisiana, homeowners are stuck in a nightmare where their insurance just disappeared. Their home values are tanking because nobody wants to buy an uninsurable house, and their only option is a state-run program that costs 3 times as much and covers half as much. This isn't some future climate change scenario. This is happening right now. Let me show you where. Big picture set up to 0:50 to 3 o'clock. Here's what's actually going on. And it's way worse than most people realize. For decades, homeowners insurance worked on a pretty simple model. You pay a premium every year. If your house burns down or gets destroyed in a storm, the insurance company pays to rebuild it. The insurance company charges enough in premiums to cover their payouts plus make a profit. Everyone's happy. Except that model completely breaks down when the disasters get too frequent and too expensive. And that's exactly what's been happening. In 2024 and 2025, the United States had $23 billion disasters. Wildfires in California caused over $100 billion in losses. Hurricanes in Florida and Louisiana caused tens of billions more. And this wasn't a one-time thing. This has been happening every single year for the past 5 years. Insurance companies aren't charities. When they start losing billions of dollars year after year in certain markets, they have two choices. Raise rates so high that they can actually cover the risk, or leave entirely. And in a lot of states, regulations make it really hard to raise rates fast enough to keep up with the actual risk. So they're leaving. State Farm controlled 20% of the California insurance market. Gone. Allstate, one of the biggest insurers in the country, stopped writing new policies in California and Florida. Farmers Insurance, same thing. Over a dozen insurance companies in Florida went completely insolvent, bankrupt. Couldn't pay their claims, just collapsed. And when private insurance companies leave, homeowners get pushed onto something called a FAIR plan, which is basically the state government's insurance of last resort. These programs were designed to cover maybe 5 or 10% of the market as a temporary safety net. In some states, they're now covering over 1 million policies with $500 billion in exposure. That's not a safety net. That's a ticking time bomb. Let me walk you through 15 places where this crisis is hitting hardest. And I'm going to be very specific about what's actually happening in each one. Number 15, Cape Coral. Florida Cape Coral is basically ground zero for Florida's insurance meltdown. This is a city that was built on drained swampland right on the coast, which in retrospect was maybe not the smartest idea. Average home insurance in Cape Coral now runs over $8,000 a year. That's not a typo. $8,000. For context, the national average is around $2,400. If you can even find a company willing to write you a policy, which is getting harder every year. Hurricane Ian absolutely demolished parts of Cape Coral in 2022, and insurance companies are still trying to recover from those losses. A lot of homeowners got pushed onto Citizens Property Insurance, Florida's state-backed plan, which tripled its policy count in just 4 years to nearly 1.2 million policies. The problem is Cape Coral's entire existence is based on people retiring there for cheap coastal living. But when insurance costs $8,000 a year plus property taxes plus HOA fees, it's not cheap anymore. And nobody wants to buy a house where insurance might not even be available in 5 years. Number 14, Paradise. California Paradise is a special kind of nightmare because it already burned down once. The Camp Fire in 2018 killed 85 people and destroyed over 18,000 structures. The entire town was basically wiped off the map. Some people rebuilt, and when they tried to get insurance, They discovered that nobody wanted to insure a town that had just been completely destroyed by fire. Premiums went from around $2,800 a year to over $9,000. Some people couldn't get private insurance at all and had to go on the California Fair Plan. The Fair Plan in Paradise cost so much that some residents saw their insurance bills fall by 800% when private insurers finally started coming back after the town rebuilt to higher wildfire standards. 800%. Think about how insane that is. Paradise is actually a success story in some ways because they adopted strict building codes and proved that resilient construction works. But it took years of fighting and tons of federal money to make that happen. Most places don't have that option. Number 13. Fort Myers, Florida. Fort Myers got hammered by Hurricane Ian, and the insurance fallout has been brutal. A lot of older homes in Fort Myers have roofs that are over 15 years old, and insurance companies are now refusing to renew policies unless you replace the entire roof. We're talking about homeowners getting letters that say your policy is canceled in 60 days unless you spend $20,000 on a new roof. Even if your current roof is fine, even if it survived the last hurricane, doesn't matter. New roof or no insurance. Average premiums in Fort Myers are over $7,000 a year now, and availability is shrinking. Some neighborhoods have entire streets where multiple houses are sitting on the market unsold because buyers can't get affordable insurance. The economic impact is starting to show up in home values. Properties in Fort Myers are selling for 10 or 15% less than they would have a few years ago, purely because of the insurance situation. Number 12. Los Angeles Fire Zones, California. The Palisades and Eaton fires in January 2025 destroyed 12,000 homes in Los Angeles. Total economic losses hit $150 billion. And those fires exposed something really ugly about California's insurance market. A huge number of the destroyed homes were in wealthy neighborhoods where people thought they had great insurance. Except a lot of them were massively underinsured because their policies hadn't kept up with construction cost inflation. People who thought they had $2 million in dwelling coverage found out it would cost $3 million to rebuild. And now, across LA's fire-prone areas, getting any insurance is a nightmare. State Farm dropped 72,000 policies in California. All states stopped writing new business. Chubb, which insures expensive homes, pulled back from high-risk areas. The California Fair Plan got hit with $4 billion in losses from those LA fires. They had to do a $1 billion assessment on all the insurance companies still operating in California, which those companies then passed on to their customers as a surcharge. So even if you don't live in a fire zone, you're paying more because other people's houses burned down. Number 11. New Orleans. Louisiana. New Orleans has always been expensive to insure because it's below sea level, in a hurricane zone. But the situation has gone from expensive to completely absurd. Average home insurance in New Orleans is now $6,700 a year, and that doesn't include flood insurance, which is separate and can cost another $2,000 to $3,000. So you're looking at $10,000 a year just to insure a house. Louisiana as a whole saw 12 insurance companies go insolvent after Hurricane Ida. Just collapsed entirely, and the companies that stayed have been jacking up rates. One projection has Louisiana homeowners insurance costs rising to almost $14,000 a year by the end of 2026. $14,000. That's more than a car payment. The state tried to fix this with tort reform and incentives to bring insurers back. It's helped a little. 10 new insurers have entered the market, but rates are still sky high and a lot of people in New Orleans are one bad hurricane season away from losing their coverage entirely. Number 10. Malibu. California. Malibu is fascinating because these are multi-million-dollar homes, and even wealthy people can't get insurance. When you're rich and you still can't solve a problem by throwing money at it, you know the system is broken. A lot of Malibu homes are now on the California Fair Plan, which is wild because the Fair Plan was designed for low-income people who couldn't get coverage anywhere else. Now it's covering $10 million beach houses. The Fair Plan in California only covers basic fire damage. It doesn't cover liability. It doesn't cover theft. It doesn't cover most of the things a normal homeowner's policy covers. So people have to buy a separate DIC policy difference in conditions, to fill the gaps. And between the two, they're paying $15,000 to $20,000 a year in insurance. Malibu's real estate market is starting to show cracks because of this. Homes are sitting on the market longer. Prices are softening. Buyers are getting scared off by the insurance situation. Number 9. The Florida Keys. The Florida Keys are basically a string of tiny islands sitting in the path of every hurricane that comes through the Caribbean. Insurance companies looked at that and said nope. Finding any homeowner's insurance in the Keys is incredibly difficult. When you can find it, premiums are often over $10,000 a year. Hurricane deductibles are typically 5% of your dwelling coverage, which on a $500,000 home means you're paying the first $25,000 of any hurricane damage out of pocket. A lot of homes in the Keys are second homes or vacation rentals. Those are even harder to insure because insurance companies consider them higher risk. Some owners have just given up and are self-insuring, which is a fancy way of saying they're gambling that nothing bad happens. The problem is the Keys are one of the most vulnerable places in America to sea level rise and hurricanes. Insurance companies know this, which is why they're not sticking around to find out what happens. Number 8. Lake Tahoe. California Lake Tahoe is a weird one because it's not a hurricane zone. It's a wildfire zone, and insurance companies are treating it exactly the same way they treat the Keys. State Farm and Allstate both pulled back from writing new policies in Tahoe. Existing policy holders are getting non-renewal notices. Some neighborhoods around the lake have seen 20 or 30% of homes lose their insurance and get pushed onto the FAIR plan. Premiums for people who can still get private insurance have doubled or tripled. We're talking about going from $3,500 a year to $9,000 or $10,000. And these are mountain homes that in some cases aren't even occupied year-round. The Calor fire in 2021 got within miles of South Lake Tahoe and almost destroyed the town. Insurance companies remember that. They're pricing in the assumption that one of these years of fire is going to make it all the way through. Number 7. Coastal Louisiana outside New Orleans, places like Houma, Thibodaux, Morgan City. Small towns in coastal Louisiana that have been getting pounded by hurricanes for years. Insurance availability in these areas has collapsed. A lot of the small regional insurers that used to cover these towns went bankrupt after Ida. The big national carriers won't touch them, so people are stuck on Louisiana Citizens, the state's insurer of last resort. Louisiana Citizens has seen its policy count explode, and premiums keep going up. The state tried to fix this by getting rid of a law that prevented insurers from dropping people who'd had coverage for 3 years. The theory was that removing that protection would bring insurers back. It might have helped a little, but it also means homeowners have way less security. Your insurer can now drop you pretty much whenever they want. One bad hurricane season, and you could get a non-renewal notice. Number 6. Santa Barbara County, California. Santa Barbara got hit hard by the Thomas Fire and then the Montecito mudslides. Insurance companies have long memories about stuff like that. Whole neighborhoods in the hills above Santa Barbara can't get traditional homeowners insurance anymore. They're on the FAIR plan paying astronomical rates. Some people are paying $12,000 to $15,000 a year just for basic fire coverage. The weird thing about Santa Barbara is it's expensive to begin with. These are not cheap homes. But when you add $12,000 a year in insurance on top of property taxes and everything else, it starts to feel unsustainable even for people with money. And the insurance situation is creating a two-tier real estate market. Homes in lower fire risk areas are holding their value. Homes in high risk areas are getting harder to sell and seeing prices drop. Number 5. Mobile. Alabama. Mobile doesn't get talked about as much as Florida or Louisiana, but it's dealing with the same insurance crisis. Hurricane Sally in 2020 caused massive damage. Several insurers pulled out of the Gulf Coast entirely. Average premiums in Mobile are now over $4,000 a year, which is high for Alabama, and availability is limited. A lot of people are discovering that the insurance they thought they had doesn't actually cover wind damage from hurricanes or has exclusions they didn't know about. Alabama doesn't have a state-backed insurance plan like Florida or Louisiana, so when private insurers leave, homeowners are stuck shopping around for whatever coverage they can find, which is often expensive and inadequate. Mobile's economy depends heavily on the port and the aerospace industry. But if insurance costs keep rising and availability keeps shrinking, it's going to make it really hard for people to want to live there. Number 4. Outer Banks, North Carolina. The Outer Banks are barrier islands. They're literally made of sand, and they're in the path of hurricanes coming up the East Coast. This is not a sustainable place to build houses, but people did it anyway. Insurance in the Outer Banks has always been expensive, but it's gotten ridiculous. Premiums of $8,000 to $10,000 a year are common. Wind and hail deductibles are often 5%, and a lot of insurers have stopped writing new policies entirely. The Outer Banks have another problem, which is that a lot of the homes are rentals. Vacation rental properties are seen as higher risk by insurers, so they're even harder to insure and more expensive. Property values in the Outer Banks are starting to reflect the insurance situation. Buyers are factoring insurance costs into their offers. Some properties are sitting on the market because buyers can't make the numbers work. Number 3. Entire counties in California's Sierra Nevada foothills. Places like Nevada County, Placer County, El Dorado County. These are the foothills east of Sacramento where a lot of people move for cheaper housing and outdoor recreation. Insurance companies have basically abandoned these areas. State Farm, Allstate, Farmers, all gone. The California FAIR Plan now covers huge percentages of homes in these counties. The FAIR Plan enrollment in California more than doubled between 2020 and 2024, going from 210,000 policies to over 460,000. A huge chunk of that growth was in these foothill counties. And the FAIR Plan is expensive. People are paying $8,000, $10,000, $12,000 a year for coverage that doesn't even include all the protections of a normal policy. They have to buy a separate DIC policy on top of it. The problem is these areas are genuinely at high risk. The Camp Fire that destroyed Paradise started in this region. The Caldor Fire came through here. Insurance companies aren't wrong about the risk. They're just not willing to take it on anymore. Number 2. Southwest Florida Gulf Coast. Naples, Fort Myers Beach, Sanibel Island, Marco Island. This entire stretch of Southwest Florida got absolutely demolished by Hurricane Ian. Insurance companies paid out over $100 billion in claims from Ian. That's not sustainable, so they started pulling out. Some went bankrupt. Others just stopped writing new policies and started non-renewing existing ones. Citizens Property Insurance in Florida has become the largest insurer in the state, which was never the plan. It was supposed to be a temporary last resort. Now it's covering over 1 million policies with exposure in the hundreds of billions. And Citizens just requested a 36% rate increase following the LA wildfires, even though those were in California. Why? Because the reinsurance market got spooked and costs went up everywhere. Southwest Florida is stuck in this trap where insurance costs make housing unaffordable. But people can't sell because buyers can't get insurance either. It's creating a slow-motion real estate crisis. Number 1. Entire state of Florida, basically. I'm putting all of Florida at number 1 because this isn't just a few bad zip codes. This is the entire state dealing with an insurance apocalypse. Florida accounts for 79% of all homeowners insurance lawsuits in the entire country. That's insane. Insurance companies are spending more money fighting lawsuits in Florida than they are in any other state. Over a dozen insurers have left Florida or gone insolvent since 2020. The ones that stayed have raised rates so aggressively that the average premium is now over $8,300 a year. Some projections have it hitting $10,000 by the end of 2026. Citizens Property Insurance, the state's insurer of last resort, went from under 400,000 policies to over 1 million in just a few years. It's now the largest property insurer in Florida, which is terrifying because it was never designed to handle that much risk. Florida tried to fix this with tort reform to cut down on lawsuits. It helped a little. Some insurers are coming back, but the fundamental problem hasn't changed. Florida is a peninsula sticking out into the ocean in the path of hurricanes. That risk isn't going away, and climate change is making it worse. Hurricanes are getting stronger. Sea levels are rising. Storm surge is getting more destructive. Insurance companies are looking at the next 30 years and deciding they don't want any part of it. The end result is millions of Floridians trapped in homes they can't afford to insure and can't sell because buyers are scared off by the insurance situation. It's a crisis with no easy solution. So what does this all mean? The home insurance crisis is fundamentally reshaping where people can afford to live in America. It's not just about premiums going up. It's about entire regions becoming effectively uninsurable by the private market. When that happens, home values drop. Economic activity slows down. People can't move to those areas for work because they can't get insurance. Banks won't approve mortgages without insurance. The whole system starts to break down. And the scary part is this is just the beginning. Climate change is making hurricanes, wildfires, and floods worse. Construction costs keep going up because of inflation and supply chain issues. Reinsurance costs are rising because global catastrophe losses are increasing. FAIR plans and state-backed insurance programs are filling the gap. But they're not a long-term solution. They're underfunded, they charge more, they cover less, and they're one major disaster away from collapse. Here's what you need to understand if you live in one of these areas, or you're thinking about moving to one. Your insurance situation could change overnight. You might have coverage today and get a non-renewal notice tomorrow. That's not hypothetical. It's happening to hundreds of thousands of people every year. If you're buying a house in a high-risk area, factor insurance costs into your budget. Don't assume you'll get the same rate your seller had. Call insurance companies and get actual quotes before you close. A house you can afford at $4,000 a year in insurance might be unaffordable at $10,000. If you already own in a high-risk area, start preparing now. Document everything about your home. Keep records of upgrades. Consider mitigation measures like hurricane shutters or defensible space for wildfires. Some insurers are offering discounts for homes that meet certain resilience standards. But also be realistic. Some areas might become genuinely uninsurable at affordable rates. If that happens, you have to decide whether you're willing to self-insure and take on that risk yourself, or whether you need to consider moving. The insurance crisis isn't a future problem. It's happening right now, and it's exposing a fundamental truth about climate risk that a lot of people don't want to face. Some places in America are becoming too dangerous or too expensive to live in. The insurance companies figured that out before anyone else because they're the ones writing the checks when disasters hit. And they've decided the math doesn't work anymore. Homeowners are getting trapped. They can't afford the insurance. They can't sell because buyers are scared off. And state governments are stuck trying to paper over the problem with programs that aren't designed to handle this kind of scale. This is what happens when you build millions of homes in flood zones, hurricane corridors, and wildfire paths, and then act surprised when nature does what nature does. The question now is what happens next? Do people accept $15,000 insurance premiums as the new normal? Do they move? Do state governments bail out the insurance market? Does the federal government step in? Nobody knows. But what's clear is the old model is broken, and we're living through the collapse in real time. So here's my question for you. If you own a home in one of these high-risk areas, what's your plan? Are you staying and hoping it works out? Are you trying to sell? Or are you just crossing your fingers that the next disaster doesn't hit you? Let me know in the comments. And if you know someone who's dealing with this insurance nightmare, send them this video. They need to know they're not alone. Subscribe if you want more brutally honest real estate intelligence that doesn't pretend everything is fine when it's clearly not. I'll see you in the next one.